Hello, everyone. It's Kali Persall, editor of Institutional Investing in Infrastructure, here with Mansi Patel, head of infrastructure debt at Principal Asset Management. And today we're just going to talk about infrastructure debt as a resilient asset class through market cycles. So, Mansi, thank you again so much for being here. Do you want to add anything about your role at Principal Asset Management or just say anything about what you do there?
Thank you, Kylie, for having me. It's a pleasure to talk to you today. Just to add in terms of my background in infrastructure, I've spent about 20 years or nearly 2 decades in the sector in the space. Spent about a year, a little over a year with Principal to build out our infrastructure debt capabilities, and really excited to chat with you today about the market and the sector and our outlook.
Fantastic. And yeah, it's so great to have you here. Definitely a timely topic. We're actually running a feature story on it in the coming September issue. And, infrastructure debt just continues to be something we hear a lot about coming up at our conferences and with our sponsors and other people in the industry. So I appreciate you taking the time to talk about it today. So with that, we'll just go right in. How does private infrastructure debt demonstrate resilience during periods of economic uncertainty or market volatility compared with traditional fixed income investments?
That's a great question, Callie. I think when you think about private infrastructure debt, it's proven its resiliency really through market cycles. As I mentioned, I've been in the industry for over 20 years, have seen the ups and downs of the market, the macro environment, and the resiliency of the asset class through very dramatic macro events, right? The energy crises in the early 2000s, the global financial crisis, commodity price shock events, resiliency through the global pandemic, which was in nobody's base case, right? Having 2 years of people not able to travel and move around at free will was a dramatic stress case for the sector, and it's proven its resiliency through that. I think the asset class have very unique characteristics. Firstly, it's the essentiality of the assets we're involved with. So their utilities, it's transportation, it's energy, it's digital, social infrastructure. These assets benefit from very consistent demand and stable cash flows, regardless of the economic environment. These are assets that move people and goods in local economies and are essential to our sponsors. They're essential to governments, and just very critical. As a result, their revenue streams are also often backed by very long-term contracts and regulated entities, regulated nature rates, which allows us to have very strong revenue predictability despite macroeconomic sectors. So I think those elements describe some of the defensive nature of the asset class. And some of the other characteristics I think that are compelling are lower default rates through those cycles and stronger recovery rates driven by asset and collateral packages that are very strong. And it demonstrates less correlation, frankly, from broader markets. Beyond that, I think, Callie, one last point would be the structural protections that these assets and deals have. Our deals nearly always are in the senior or secured parts of the capital structures, and they have strict covenant packages, strict collateral packages, and we benefit from direct lender relationships, allowing for more proactive management. So putting all that together makes infrastructure debt a very attractive and resilient asset class, we believe, for portfolio construction.
Yeah, thank you so much. Lots of good points there. So with 3.6 trillion in annual infrastructure investment needs projected through 2030, which specific sectors or trends do you believe present the most compelling opportunities for infrastructure debt investors?
Yeah, I think you're right. There is an enormous need across very broad sets of sectors and subsectors. When we think about our strategy and where we see the most macro tailwinds supporting growth is across really five core sectors. And the first being digital infrastructure. So there, think of data centers, fiber, telecom, towers. Secondly, power. We see a lot of need for growth in power supported by the digital growth, right? There's a correlation between those two sectors. So we see growth in renewable generation, traditional gas generation, energy storage, grid modernization. Thirdly, energy is a sector we do see a lot of tailwinds in as well. Midstream pipelines, LNG export terminals, and global energy sectors more broadly. And I would add transportation continues to be a core element of all infrastructure books, I believe. That's driven by modernization needs, upgrades, and expansions of core assets. Think of those as your airports, your ports, your roads, your rail. So a very key fundamental element of infra investing overall. And then lastly, social infrastructure, which we do see a lot of positive growth in as well. There it's healthcare, it's education, it's government buildings, it's social infrastructure like entertainment venues. So we see those are the five sectors that my teams are focused on. We see a lot of opportunity set globally across of them.
Thank you. Can you just discuss how infrastructure debt offers diversification across geographies and sectors? I know you mentioned a few right now, and just talk about how that supports long-term portfolio resilience.
Yeah, it's a great question. I would say that portfolio construction for infrastructure debt allows for geographic diversification across Americas, in Europe, in Asia, in LATAM, and in Africa, actually. So there's developed markets and emerging markets where we see opportunity sets, all driven by our prior discussion around the growth around those core sectors. I think when you step back and you think about what infrastructure can bring to a portfolio, it's access to borrowers and sectors that don't exist in the public markets because of the nature of the deals that we see. Perhaps at scale, it's privacy, it's issuers wanting a bespoke bilateral debt solution. So it just allows for greater access and issuer diversification on portfolio construction as well. I think in addition to sector, geography, and issuers, we also have very specific bespoke debt structures that we can provide to our clients. We've got clients that have very short duration needs, they've got long duration needs, and anywhere in between. And the sector is allowed to customize a portfolio driven by ALM matching needs for our clients.
Great, thank you. I mentioned earlier a little bit how we're hearing a lot more about infrastructure debt. How has investor appetite for infrastructure debt evolved in recent years? And especially in light of that growing global focus on sustainability and demographic shifts. Have you seen any change there?
Yeah, we continue to see a lot of growth in the space. 20 years ago, there was not really an infrastructure market, right? Bluntly, it was a project finance bank loan market. And that has over the years evolved into an institutional infrastructure debt market where players in the private sector can participate alongside the banks and support our private sector sponsors. So there is tremendous growth. That also comes with a lot of appetite from clients for all the things we talked about, portfolio diversification, duration, covenants, collateral, assets that they don't see elsewhere, liquidity premiums. Being a private market, you're enabling higher yield assets, frankly, from traditional public fixed income because of the elements of the trades and the illiquid nature of the sector. And so putting all that together, we've seen a tremendous need from our investors in the space. We see interest across real assets. So with our real estate experience and expertise in adding infrastructure capabilities into a real assets offering has been quite compelling from our clients' lens. And so putting that together has created a lot of opportunity for principal and overall in the market on infra debt. I think we'll continue to see that trend and that stable long-term returns and diversification benefits is consistently in need from what we see across our client base. And now that the sector has proven its resiliency through market shocks, and there's a lot of quantitative data now to support the analytics, we do see a lot of appetite and interest.